Coming to the index, so today we are going to talk about the introduction, core components of business, about the business key financial statements, importance of annual reports, and then we talk about understanding financial statements, corporate governance overview, introduction to financial ratios, and then we would end with historical performance analysis of a company. So basically, what is an annual report? An annual report is a comprehensive and official document that a company publishes on a yearly basis to provide information about its financial performance, operations, and overall activities over the past fiscal year. And this report is typically intended for the company's shareholders, potential investors, analysts, and other stakeholders who are interested in gaining insights into the company's financial health. So the key insights that investors should look for in an annual report should be its financial performance, its management discussion and analysis, risk factors, corporate governance, and outlook and strategy. So an annual report basically reflects the company's overall health by providing a holistic view of its financial position. Coming to the core components of business, the core components of business are its value proposition, customer segments, revenue streams, cost structure. Now, what does it mean by value proposition? So, value proposition basically articulates the value the company offers to its customers. Now, this could be in the form of products, services, solutions that address customers' needs or problems. Coming to the customer segments, it's important to identify the target customer groups or market segments that the company aims to serve. So we basically need to understand the characteristics and preferences of these segments, which is crucial for effective marketing and product development. And cost structure outlines the major costs and expenses associated with running the business. Now, this can include both fixed and variable costs, such as production costs, marketing, and expenses. And revenue streams include how does the company generate income from its products and services. Now we'll talk about how does company's business model impact its financial stability. So a company's business model is puts a very significant impact on its financial stability, as it determines how the company generates revenue and manages its costs. And there are several ways in which a business model can influence financial stability. That includes revenue generation, which means that how does the core of any business model is that how a company generates revenue. Cost structure, which means that how does the business manage its upfront costs and ongoing expenses. So there might be companies which involve high upfront costs but lower ongoing expenses, while others may have continuous variable costs. Third is higher profit margins, which is that how are the profit margins associated with the business model, and how are the profit margins also associated with the cost structure of the company. So there might be industries which naturally have higher margins than others, and it can be noticed that the companies with healthier profit margins are generally better equipped with economic downturns, with unexpected or unforeseen circumstances. And then it's also very important to diversify, to have a diversified portfolio, as if a company has only been generating revenue from just one stream, then that can be also exposed to more losses than company which has a diversified portfolio. Then competitive landscape is also important. The level of competition within an industry can impact financial stability. Adaptability to market changes means that the companies who are better equipped with unforeseen circumstances and they have a robust business model that's adaptable to changes in the market. Now we can also talk about diversification of revenue. Next slide is about the key financial statements. So the three key financial statements included in an annual report are income statement, balance sheet, and cash flow statement. So how are these statements interrelated? Basically, income statement reflects a company's profitability over time. Balance sheet provides a snapshot of its financial position at a point of time, and cash flow statement details how changes in balance sheet and income statement account affects cash. And together, these statements offer a comprehensive view of the financial model of a company. Now, there are many common misconceptions when people come on reading the financial statements. Some of them are that there has been a mentality that higher revenue equals higher profit, which is completely untrue, because higher revenue can also lead to higher profit. Higher revenue is basically costs. Profit is basically revenue minus costs. There can also be chances of higher costs, which cannot lead to higher profit. So there has been a common misconception that higher revenue equals higher profit. And then ignoring notes and footnotes, overlooking changes in accounting policies, not considering industry norms, and neglecting future considerations. These things are common misconceptions in the industry when it comes on reading financial statements. Now, what should be the frequency of review for small investors? So, small investors or retailers should be seeing financial statements quarterly or semi-annually. There can be situations where they're going to make significant investment decisions, and then they can have a look at financial statements. During earnings seasons, majorly investors should look at the financial statements or follow news. And the active traders, the small retailers who are trading daily, can also regularly monitor any financial news that's coming in the market. Why regular monitoring is essential? Small investors may not need to review financial statements on a daily basis. A balanced approach can also is just necessary. Now, the question that why is financial statement? What is the importance of annual reports? So there are many advantages of having annual reports at hand, but some of them are that annual reports give you a full financial picture of a company, because they contain audited financial statements which offer a complete picture of a company's income, expenses, assets, liabilities, and cash flow. Second can be strategic direction, which means that annual reports outline the company's strategic initiatives, business model, and MD&A, which is management's discussion and analysis of the past year's performance, which includes that what does the management think of the financial model that the company has, or the annual statements that the company has. Annual reports also show us the risk factors. It discloses potential risks and challenges the company may face, helping investors assess the risk-reward profile. Then it also tells us about the corporate governance, which is that information on executive compensation, board structure, and shareholder rights, and that provides insights into corporate governance practices. Now, what are the basic skills that one needs to understand financial statements? So, majorly, one should have financial literacy, which means that they should know the financial concepts and accounting principles, which includes terms such as assets, liabilities, equity, revenues, and people should know what is the meaning of these terms, and various financial ratios. Then industry knowledge. Whenever someone is going to analyze the industry, they should have the knowledge, which means that in which the company operates, and that will help them in contextualizing or analyzing financial data. Different industries have unique financial metrics and benchmarks which one must be aware with. Third is attention to detail. Financial statements contain detailed information, and a keen attention to detail is necessary to identify discrepancies. And critical thinking, which means that the ability to critically evaluate information and make judgments. Making informed judgments is important, and that involves asking questions about the reasons behind certain financial figures and logically justifying their judgments. Then it comes to company's market position and industry analysis. So where does the company stand in its market compared to its competitors? In order to see where does the company stand in the market, we should look at market share, product differentiation, brand strength. Now, market share means that it helps in understanding the company's market share compared to competitors, which provides insights into its dominance in the market. So the attached graph is about the Aegis Logistics, which tells us the market share of Aegis Logistics in logistics industry. And as logistics industry is very fragmented in Indian market, we can see that Aegis Logistics also does not has a major market share in India. Product differentiation. This means that companies that can differentiate their products or services effectively, they often have a competitive edge. And brand strength. A strong brand can contribute to a company's market position, influencing consumer preferences. So consumers would like to go to a brand which is famous and which is known. So brand strength also plays a major role in company's market position. A company's market position can significantly impact its financial health. So what are the major factors that would get affected by a company's market position? That would be revenue growth. A strong market position can contribute to higher sales and revenue growth. Profitability. Companies with a dominant market position may have higher profits. And access to capital. Now, a company which has higher revenue growth and higher profitability can make it easier to access capital for expansion or investment. Key management and board members. Now, how do these individuals' backgrounds and experiences contribute to company success? So, first point is strategic direction. Now, that means that board members with diverse professional backgrounds bring a variety of perspectives to strategic discussions. And board members which have more industry knowledge or relevant industry expertise, they can also provide valuable insights into market trends and competitive landscapes. Financial acumen is, of course, very important for key management and board members. So board members with financial expertise can contribute to effective financial management. Leadership skills. Now, board members with leadership experience bring valuable skills in organization development, and it's easier for them to have an organized staff. And then global perspective. Business operate in an increasingly interconnected world. Board members with international experience can provide a global perspective. Coming to the next slide, which talks about corporate governance overview. Now, what is the corporate governance overview? So it refers to the system of rules, practices, and processes by which a company is directed, controlled, and operated. It involves the relationships among various stakeholders such as shareholders, management, board of directors, employees, customers, suppliers, and the community. So the key components of corporate governance include board of directors, shareholder rights, transparency and disclosure, ethical behavior and CSR, which is corporate social responsibility, which every industry has to adhere to, risk management, stakeholder management. These are some of the points the company that the industry has to have in mind in order to run a company. Now, what are the indicators of strong corporate governance in a company? So, strong corporate governance means that how much are the company's structures and processes effective, and they are aligned to its activities with the interests of stakeholders, and that also promotes ethical behavior and ensures accountability. Some of the key indicators of a strong corporate governance is independent board of directors, which means that there is no bias between BODs and the management of the company. Then board composition and diversity, and then shareholder rights and engagement. These are just some of the points which ensures that there is a strong corporate governance. Coming to introduction to financial ratios. Financial ratios are very important to assess the company's financial models. There are four kind of majorly there are four kind of financial ratios. Four of them are liquidity ratios, profitability ratios, efficiency ratio, and solvency ratios. Now, liquidity ratios includes current ratio and quick ratio. These are basic financial metrics that assess a company's ability to meet its short-term obligations with its liquid assets. Profitability ratios include net profit margin and ROE, return on equity. These ratios assess the company's ability to generate profits from its operations. Efficiency ratio includes two of them, inventory turnover and accounts receivable turnover. And solvency ratio includes debt to equity ratio and interest coverage ratio. Interest coverage ratio is basically, it indicates a company's ability to cover interest expenses with its operating income. And debt to equity ratio measures the proportion of debt used to finance the company's assets. Legal and ethical considerations. So These are some of the legal and ethical considerations that the company has to keep in mind. First one is that they have to adhere to generally accepted accounting principles and accounting standards. Then they have to adhere to SEBI regulations, ICAI policies, GST compliance, and then there is Companies Act 2013. Now, if these companies do not adhere to these legal considerations, to these laws, then the consequences can be that there can be legal repercussions, there will be significant reputation damage, then financial losses for investors. And in order to, investors can take several steps to ensure a company's reports are legally and ethically compliant, with ensuring that there are independent audits and these audits are by some reputed firms and are not biased in any way, governance practices, regulatory filings, and then due diligence. Now, what are the factors that evaluate companies' financial health? So, key indicators for evaluating financial health is revenue and profitability. In order to see that whether this company is financially healthy or not, we have to look at its revenue and profitability, which means that we have to look at how has been what are the revenue trends over the past few years of a company, analyze net income and operating margins to assess profitability. Second is debt levels. We have to see that, examine the company's debt to equity ratio to gauge its leverage. Then ROIC, which is return on invested capital. It means net operating profit after taxes is divided by invested capital. It measures the efficiency of capital utilization. Then earnings growth, which means that year over year or period over period percentage change in earnings. Liquidity, it assesses the current and quick ratios to determine the company's short-term liquidity and ability to cover its immediate liabilities. And cash flow. Cash flow means to analyze operating cash flow to ensure the company generates sufficient cash to cover its operational needs or expenses. Now, how can the historical performance analysis, how has company performed financially over the past 5 years? In order to know this, we should look at revenue and profit trends, which means to assess the company's revenue and profit growth or decline over the past few years, whether the company has contracted or expanded. Then operational efficiency, which means that to analyze operational metrics and efficiency ratios. And for this, we need to know the financial ratios. Then third is market share and positioning, which we have already covered, that how much is the market share of the company and how is it positioned in the market, because that would tell us about the future of the company. So we have to evaluate changes in the company's market share and competitive positioning and also know the reasons behind it. Fourth is debt levels and financial health. So we need to examine the company's debt levels and overall financial health. Now, what are the factors that influence historical performance? Some of the reasons are industry trends. We need to understand the broader trends in the industry, market conditions, see how changes in the market conditions have influenced the company and how much robust the business model the company has, and how much is it adaptable to market conditions. Third is management decisions. We need to assess the impact of management decisions such as mergers and acquisitions on the company. That how has their decisions impacted the finance of the company. And fourth is economic factors, which explores how economic factors have affected the company. That's it. Thank you.